Joining us now, Peter Mallouk, the president and CEO of Creative Planning. It's good to see you. Welcome to Closing Bell.
Hey, it's great to be with you.
So obviously it jumps out to me first on the list of the things you say you don't like within tech. Nvidia is on the list. What?
Look, tech's got a long way to go. A lot of people, clients ask us, well, how long is this tech rally going to continue? And I tell them, for the rest of your life. I mean, we're in the middle of a revolution, and we're in the middle of an AI revolution, and chip makers are going to do well for decades. But with Nvidia, I don't know when it's going to pause, but it is going to pause. And what is different about Nvidia is I would not equate it to Apple as a company that has a significant moat that's going to protect it for all time. I would put it in the same boat I put a company like Netflix or Tesla, which is just an incredible company. It's an innovative company. Who knows how much longer it has to run, but it doesn't have a moat. It has a head start, and those are very, very different things. And companies with a head start, the market eventually catches up with them. Yes, the AI revolution can continue, but that does not mean all the eggs should be in the Nvidia basket.
But if you have the best and most powerful component that seemingly almost, and I'm putting this in quotes, everyone needs,
yes.
That has to be a bit of a moat, especially if you incorporate the head start you suggest, the amount of money they're able to charge for the transformative chips that they have. It has to be a little bit of a moat somewhere, no? I mean, come on.
Yeah, I would say everything you said is correct, and I would add the words "for now" to the end of it. Yeah, everyone needs it. There's not a lot of alternatives. The competitors are going to get started. You've got the AMDs of the world, Intels of the world, but you're also going to have these other players like Oracle that are coming. There's going to be all kinds of companies that are going to come into this space. They are going to be successful. They're going to figure it out, and they are eventually going to catch up. And when we see that, this sales to earnings ratio is going to come back down to earth. That might be a couple years. It might be a couple months. I'm not big on timing the short run. The space is for real. This company is for real. But at some point, people are going to regret if they've got all their eggs in one basket. I'm all for having it as part of an index or having a significant position as part of your portfolio as a bet on this space. But look, I've seen a lot of people that have come to us. This is 20, 50, 60% of their portfolio. They think it's the new Apple. It's not the new Apple. It's a leader in its space. It's innovative. It's an incredible company. But Apple does not have competitors that are real competitors that really threaten its business enterprise. Nvidia has real competitors. They're going to catch up in a few years. We're going to see a lot of them emerge and be successful.
Do you guys own the stock?
We do, because the largest part of most of our clients' portfolios is index-based. It's one of the largest performing positions, for our clients that have that large cap position that most of our clients do. They've reaped a lot of reward from Nvidia. We've seen these big tech stocks lift up, for example, the S&P 500 year over year over year, where everyone says, well, the S&P 500 is terrible except for Apple, or the S&P 500 is terrible except for Facebook, and this year it's terrible except for Nvidia and a couple other names. Well, that's the point of owning a diversified basket of large stocks. About 30-40% of it's going to be technology. And these winners, a loser can only go down 100%. A winner can go up 1,000%. That's kind of the whole point of taking that approach. You don't have too many eggs in one basket, but you're still participating in the upside when these runaway companies happen.